Lately, I've been thinking a lot about retirement, not because I'm planning for it. At my age, people often assume retirement is all I think about, but the truth is, I've spent far more time studying how other people retire than worrying about myself. And after watching thousands of people approach retirement over many decades, I've noticed a pattern that concerns me. Most people spend 40 years working, earning, saving what they can, and hoping everything somehow works out in the end. Hope becomes the strategy. The problem is that retirement doesn't reward hope. Retirement rewards preparation. By the time someone reaches 65 and realizes they don't have enough money, the most valuable ingredient in wealth building has already disappeared. Time. You can always earn more money, you can always reduce expenses, but you cannot recover decades that were never invested. That's why retirement planning is so important. It's not about predicting the future perfectly. It's about creating a structure that can survive uncertainty. Most people focus on how much money they need. I think that's the wrong question. The better question is what assets will produce the income, stability, and protection required to support you for the rest of your life. Because retirement isn't a number, it's a system. And today I want to talk about 5 assets that can make that system dramatically stronger. The first asset may be the most important of all: businesses. Not just any businesses, but strong companies that consistently share profits with their owners. Most people call these dividend-paying stocks. I call them income-producing assets. Think about what happens when you retire. The paycheck stops. Every expense remains. The challenge becomes obvious. Where does the income come from now? Many retirees solve this by selling investments. They gradually withdraw money from their portfolios and hope the balance lasts long enough. But there is another way. Instead of selling assets, you can own assets that send money to you. That's what quality dividend-paying companies do. They generate profits and distribute a portion of those profits to shareholders. The beauty of this model is that your ownership remains intact. You're not consuming the asset itself. You're living on what the asset produces. This distinction is incredibly important. Over long periods, strong businesses tend to grow earnings. As earnings grow, dividends often grow as well. That means your income has the potential to rise while your ownership remains unchanged. That's a powerful combination. It creates a retirement income stream that can continue for decades, not because you're withdrawing money from yourself, but because productive businesses are generating value on your behalf. One mistake people make is chasing the highest dividend yield they can find. That approach often leads directly into trouble. High yields frequently exist for a reason. Sometimes the business is struggling. Sometimes the dividend is unsustainable. Sometimes investors are simply overlooking risks. In retirement, reliability matters far more than excitement. I'd rather own a company that steadily increases its dividend for 30 years than one offering an unusually high payout today. Consistency wins. Think about businesses people use every day, products purchased repeatedly, services customers depend on, brands that have survived multiple economic cycles. Those are the types of businesses that often become excellent retirement assets. They may not dominate headlines. They may not double overnight. But retirement isn't about excitement. It's about confidence. Confidence that income will continue arriving regardless of market noise. Confidence that the underlying business will still exist 10 or 20 years from now. The older I get, the more I appreciate durability. Great retirement assets don't need to be spectacular. They simply need to keep working year after year. That's what quality dividend-paying businesses have done throughout history. And that's why they form the foundation of so many successful retirement plans. The second asset surprises some people because it seems almost too simple. A low-cost index fund. Whenever investors ask me for complicated strategies, I'm usually disappointed. Wealth building is often much simpler than people expect. An index fund allows you to own hundreds of businesses simultaneously. You're not trying to predict which company will dominate next year. You're owning a broad collection of productive enterprises. This approach removes a tremendous amount of guesswork. Instead of depending on one company, one industry, or one management team, you're participating in the growth of the overall economy. That's powerful because economies tend to expand over long periods. Businesses innovate, productivity improves. Profits grow, and owners benefit. Retirement requires both income and growth. Dividend stocks help provide income. An index fund helps provide growth. Think of it as your backup engine. While one portion of your portfolio generates cash flow today, another portion quietly compounds for the future. This matters because retirement can last 30 years or longer. A portfolio that stops growing eventually becomes vulnerable. Inflation continues, expenses increase, life changes, growth remains essential even after retirement begins. One of the greatest advantages of an index fund is simplicity. Simplicity is underrated in finance. People often assume complexity equals intelligence. Usually the opposite is true. The best investment strategies are often remarkably simple. Buy productive assets, hold them patiently, let time work. That's essentially what an index fund allows you to do. There are no constant decisions, no endless predictions, no need to react to every headline. You simply own a portion of hundreds of businesses and allow compounding to operate. Most investors struggle not because investing is difficult, but because they interfere too much. They buy, they sell, they panic, they chase trends, they attempt to outsmart markets. Meanwhile, patient investors quietly allow decades to pass, and decades are where wealth is created. Retirement planning works the same way. The earlier you begin building ownership, the more powerful compounding becomes. Time transforms ordinary decisions into extraordinary outcomes. That's why a low-cost index fund belongs in almost every retirement strategy. It provides diversification, growth, and simplicity all at once. And simplicity is often the greatest advantage an investor can possess. The third asset I believe every retirement portfolio should contain is income-producing real estate. Notice I didn't say a larger home. I didn't say a vacation property. I said income-producing real estate. There's an important difference. Many people assume their home is their greatest investment. In reality, a home primarily consumes money, property taxes, maintenance, insurance, repairs, utilities. These costs never disappear. An investment should put money into your pocket, not take it out. That's why rental properties have been one of the most reliable wealth-building assets for generations. Every month, tenants contribute to your income stream. Over time, rents tend to rise. Property values often appreciate, mortgages eventually get paid off. The result is an asset capable of producing cash flow for decades. Retirement becomes much easier when multiple income streams exist. If one source experiences difficulty, another continues operating. That's what real estate provides: stability, diversification, and perhaps most importantly, protection against inflation. As living costs increase, rental income often increases as well. This makes real estate uniquely valuable for retirees because inflation is one of the greatest threats to long-term financial security. The goal isn't becoming a real estate mogul. The goal is owning productive assets that continue generating income when your career no longer does. Now, I understand that not everyone wants to manage tenants, repairs, or property maintenance. That's perfectly reasonable. Retirement should create freedom, not additional headaches. Fortunately, there are alternatives. One of the simplest is owning shares in real estate investment trusts, often called REITs. These businesses own and manage large collections of income-producing properties: office buildings, apartments, warehouses, healthcare facilities, shopping centers. Instead of buying an entire property yourself, you own a small piece of many properties through the trust. The income generated by those properties is distributed to shareholders. In many ways, it's similar to owning dividend-paying stocks, except the underlying asset is real estate. This approach provides exposure to rental income without requiring direct management responsibilities. What matters isn't the method. What matters is participation. Retirement portfolios benefit from assets that behave differently. Stocks, real estate, inflation-protected securities, and cash flow-producing businesses all respond differently to economic conditions. Diversification isn't about maximizing returns. It's about reducing the probability of catastrophic outcomes. That's why real estate, whether owned directly or through REITs, deserves a place in a retirement strategy. The fourth asset isn't exciting. In fact, it's probably the least exciting asset we'll discuss. But sometimes boring assets perform incredibly important jobs. This asset exists for one reason: protecting purchasing power. Most retirees underestimate inflation because inflation doesn't arrive dramatically. It arrives gradually. One year prices rise slightly, then another year, then another. Over a decade, the effect becomes substantial. Suddenly groceries cost more, healthcare costs more, insurance costs more, everything costs more. Yet many retirement plans assume expenses remain relatively stable. That's a dangerous assumption. Inflation quietly erodes Financial security. That's why inflation-protected government securities can be so valuable. They aren't designed to make you rich. They're designed to preserve purchasing power. Think of them as financial insurance. You don't buy insurance because you expect disaster. You buy insurance because disaster is possible. Inflation protection works the same way. Most of the time, your stocks and real estate will likely outperform. But during periods of elevated inflation, these securities provide stability. Retirement isn't just about growth. It's about defense. Great portfolios contain both. One lesson I've learned over many decades is that successful investing resembles baseball more than gambling. You don't win by swinging as hard as possible every time. You win by staying in the game. Retirement works the same way. The greatest financial threat isn't necessarily earning lower returns. It's being forced into bad decisions during difficult periods. That's why defensive assets matter. They create flexibility. They allow you to avoid selling investments at the worst possible moments. Imagine entering retirement during a major market decline. If your entire portfolio depends on stock appreciation, the pressure becomes enormous. But if portions of your portfolio continue generating income and maintaining stability, you gain options, and options are incredibly valuable during uncertainty. Inflation-protected securities won't generate headlines. Nobody brags about them at dinner parties, but that's precisely why they work. They're designed to quietly perform their role when needed. Retirement planning isn't about excitement. It's about creating a system capable of surviving decades of unpredictable events. Stability deserves far more respect than most investors give it. The fifth asset surprises many people because earlier I said a personal residence isn't an investment. I still believe that's true. However, a paid-off home can be one of the most powerful retirement assets available, not because it generates income, but because it dramatically reduces expenses. There's an important difference. Retirement isn't only about increasing income. It's also about lowering the amount of income required. Imagine two retirees. One needs $80,000 annually to support their lifestyle because they still carry significant housing costs. The other needs only $55,000 because their home is paid off. Which retirement is easier to sustain? The answer is obvious. Lower expenses create flexibility. Flexibility reduces stress, and reduced stress creates freedom. That's why eliminating housing debt before retirement can be so valuable. Every mortgage payment eliminated is income you no longer need to generate. Financial independence isn't solely about how much money you have. It's about how much money you need. The lower your required expenses, the stronger your retirement position becomes. That's why a paid-off home deserves a place on this list, not as an investment designed to grow wealth, but as a strategic asset designed to protect it. Sometimes the smartest financial move isn't increasing income, it's reducing obligations. Now let's talk about the mistakes that quietly destroy retirement plans. The first mistake is believing retirement automatically means moving most of your money into bonds. For decades, that advice was repeated so often that people accepted it without question. The logic sounds reasonable. Retirement means safety. Bonds are considered safe. Therefore, retirement should equal more bonds. But the world has changed. Inflation changes everything. A portfolio that grows too slowly may appear safe on paper while quietly becoming weaker every year. Imagine retiring at 65 and living until 95. That's 30 years. A portfolio that fails to keep pace with rising costs can become surprisingly fragile. The challenge isn't surviving 1 year of retirement. The challenge is surviving 3 decades. That's why growth still matters. Retirement is not the end of investing. It's simply a different phase. You still need assets capable of increasing income, preserving purchasing power, and adapting to economic changes. Too much safety can become dangerous. The goal isn't eliminating risk. The goal is managing it intelligently. That's why strong businesses, productive real estate, and long-term growth assets remain important even after retirement begins. Safety without growth often creates a different kind of risk, running out of money slowly. The second mistake is retiring without enough income-producing assets. This happens more often than people realize. Someone builds a portfolio worth hundreds of thousands of dollars, maybe even $1 million, but the portfolio produces very little actual income. Everything depends on selling investments. Every withdrawal reduces ownership. Every market decline creates anxiety. Every economic downturn feels threatening. That's not how retirement should feel. Retirement works best when assets generate income naturally. Dividends arrive, rental payments arrive, interest payments arrive, money flows toward you instead of requiring constant withdrawals. This creates emotional stability as much as financial stability. One of the most overlooked benefits of income-producing assets is psychological. During difficult markets, retirees who receive ongoing cash flow tend to remain calmer. They don't feel pressured to react. They don't feel forced to sell. They can simply allow markets to recover while continuing to receive income. That's a powerful advantage. Retirement isn't just mathematics, it's behavior, and behavior often determines outcomes more than spreadsheets ever will. Another mistake I've seen repeatedly is carrying large debts into retirement, particularly mortgages. People often underestimate how much pressure debt creates when income becomes fixed. During your working years, a mortgage may feel manageable because a paycheck continues arriving. Retirement changes that equation. Suddenly every monthly payment matters more. Every expense requires a larger percentage of your available income. A paid-off home doesn't generate income, but it dramatically reduces the amount of income required. That's why I consider it one of the most valuable retirement assets available. It creates breathing room. It reduces stress. It gives retirees flexibility during difficult periods. Some people argue that low-interest mortgages should always remain because investments can generate higher returns. Sometimes they're correct mathematically. But retirement is not purely a math problem. It's also a risk management problem. Financial freedom feels very different when housing costs are minimal. The peace of mind alone can be worth more than a slightly higher return. Wealth isn't only about maximizing numbers. It's about creating a life where financial worries occupy less space. That's what a paid-off home often provides. The final major mistake is waiting too long. This is the one mistake nobody can fully correct later. Every other financial error can be improved. Debt can be reduced. Expenses can be lowered. Portfolios can be adjusted. But lost time never returns. Retirement planning rewards consistency far more than intensity. Most people assume they'll become serious about retirement later. Later becomes next year. Then 5 years. Then 10. Eventually retirement begins appearing on the horizon and panic replaces confidence. Compounding requires years. Dividend growth requires years. Mortgage reduction requires years. Real estate appreciation requires years. Nothing replaces time. That's why the most important retirement decision is usually the first one. Open the account. Make the investment. Buy the first asset. Begin the process. The amount matters less than the habit. Wealth grows from consistency. People often underestimate what small actions can become when repeated over decades. Retirement planning isn't built through dramatic moves. It's built through ordinary decisions made repeatedly over very long periods of time. So let me leave you with one final thought. Retirement is not a destination you magically arrive at. It's the result of thousands of decisions made long before retirement ever begins. Every dollar invested, every debt payment made, every asset acquired, every unnecessary expense avoided. These decisions compound into a future reality. I've watched people enter retirement with confidence because they spent decades building productive assets. I've watched others enter retirement with fear because they spent decades hoping things would somehow work out. The difference was rarely intelligence, it was preparation. The 5 assets we've discussed are powerful because each one solves a different problem. Dividend-paying businesses provide income. Index funds provide growth. Real estate provides diversification and inflation protection. Inflation-linked securities defend purchasing power. A paid-off home lowers expenses. Together they create a structure capable of surviving uncertainty, and uncertainty will always exist. Markets will fluctuate. Inflation will appear. Unexpected expenses will arrive. That's life. The goal isn't predicting every challenge. The goal is owning assets strong enough to handle them. Retirement should not be a period defined by financial anxiety. It should be a period defined by freedom, flexibility, and peace of mind. But that outcome doesn't happen automatically. It happens because someone spent years preparing for it. Start now. Stay consistent. Let time work in your favor. Because when retirement finally arrives, preparation will matter far more than intentions ever did.